cover business of stock market. The second will cover mindset for investing in stock market. And the third will cover management of risk in securities market. So moving forward, the first aspect, businesses of stock market. Stock market investment is one such lucrative option that rewards investors with high returns over the years. But to make this kind of return, it is important to understand how the equity market works. For that, we will be discussing 4 key participants involved in the Indian stock market. The first important participant is SEBI. SEBI is Securities Exchange Board of India. SEBI is the regulator of stock markets in India. It ensures that securities market in India work efficiently and transparently. It also protects the interests of all the participants and none gets any undue advantages. SEBI lays down regulatory frameworks that exchanges, companies, brokerages, and other participants must abide by to protect investors' interest. So assume SEBI as supreme court of all the stakeholders of investment. The second participant is stock exchange. The stock market allows investors to trade shares, bonds and derivatives. This trading is facilitated by stock exchanges. In India, there are 2 primary stock exchanges. Bombay Stock Exchange, Sensex is the index. The National Stock Exchange, Nifty is the index. Bombay Stock Exchange is one of the oldest index. Third key participants are stockbrokers and brokeragers. A broker is an intermediary, a person or a firm that executes buy and sell orders for investors in return for a fee or a commission. Hence, no person can directly buy or sell shares from NSE or BSE. A broker has to be in between to buy and sell the shares. The fourth key participant is investors or traders. Stocks are units of company's market value. Investors are individuals who purchase stocks to become part owners of the company. Trading involves buying or selling this equity. Markets. There are 2 types of market: primary and secondary markets. Primary markets. The primary stock market provides an opportunity for issuers of stocks or companies to raise capital to meet their investment requirements. A company lists its shares in the primary market through an initial public offering or IPO. Through an IPO, a company sells its shares for the first time to the public. An IPO opens for a particular period. Within this window, investors can bid for the shares and buy them at the issue price announced by the company. That window lies for 3 to 5 days, depending upon the company. Once the subscription period is over, the shares are allotted to the bidders. The companies are then called public because they have given out their shares to the common public. For this, companies need to pay a fee to the stock exchanges. They are also required to provide all important details of the company's financial information, such as quarterly annual reports, balance sheets, and income statements, along with information on new projects or future objectives to the company, to the stock markets. Secondary market. The last step involves listing the company on the stock market, which means the stock issued during the IPO can now freely be bought and sold. So those who could not get the IPO allotment can now buy that particular share in the secondary market. The secondary stock market is where shares of a company are traded after being initially offered to the public in the primary market. As you can see in this diagram, first the company enters the primary market, then the company gets listed itself, then company issues the IPO, the shares are distributed to the public, and then secondary market trading begins. Trading in the stock market. Once listed on the stock exchanges, the stocks issued by companies can be traded in the secondary market. This buying and selling of stocks listed on the exchanges are done by stockbrokers or brokerage firms that act as the middlemen between the investors and the stock exchange. The broker passes on your buy order for shares to the stock exchange. The stock exchange searches for a sell order for the same share. Once a buyer and a seller are found, a price is agreed to finalize the transaction. Post that, the stock exchange communicates to your broker that an order has been confirmed. This message is then passed on to investor by the broker. All this happens in real time and in seconds. Meanwhile, the stock exchange also confirms the details of the buyers and sellers of the shares to ensure the parties don't default. It then facilitates the actual transfer of ownership of shares from sellers to buyers. This process is called the settlement cycle. Earlier, it used to take weeks to settle stock trades, but now this has been brought down to T+2 days in India, which is T+1 currently in phases. Stockbrokers identify their clients by a unique code assigned to an investor. After the transaction is done by an investor, the stockbroker issues him/her a contract note which provides details of the transaction such as the time and date of the stock trade. Apart from the purchase price of a stock, an investor is also supposed to pay a brokerage fees, stamp duty, and securities transaction tax. In the case of sale transaction, these costs are reduced from the sale proceeds and then remaining amount is paid to the investor. At the broker and stock exchange levels, there are multiple entities or parties involved in the communication chain, like the brokerage order department and exchange floor traders. Look at the diagram. In this, you can see buyer gives the order to broker 1 and then it goes to stock exchange. Similarly and simultaneously, the seller gives the order to broker 2 which goes to stock exchange. At stock exchange, both the orders are matched along with the prices, which are then informed to both broker 1 and broker 2, and the settlement is done. Pricing of shares in the stock market. Demand and supply for a stock play an important role in the changes in share prices as well as in determining the price of a share. Just keep this small concept in mind. When the demand for shares is more than supply, the price rises. When the demand for shares is less than supply, the price falls. It is similar to the goods in the common retail market. The Indian stock exchanges BSE and NSE have algorithms that determine the price of stocks based on the volume traded, and these prices change pretty fast. The second aspect of this unit is mindset for investing in stock market. First, Enhance your knowledge. When you're investing in the stock market, it's important to invest your valuable time enhancing your knowledge and in the stock that you're investing in. Knowledge is what gives you confidence in what you're investing. Warren Buffett says, the best investment you can make is an investment in yourself. The more you learn, the more you earn. Next, be patient and disciplined. The best way to measure investing success is not by whether you are beating the market, but by whether you have put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. This was the quote by Benjamin Graham. The stock market is a device for transferring money from the impatient to patient. Warren Buffett. With patience, you can manage your money effectively with better control over emotions in every market situation to ultimately achieve your goals. Therefore, investment must be boring. It is not exciting, and one should be very patient and disciplined while investing. Keep a long-term outlook. Once you invest, sticking with the stocks for a longer term is the right way to be successful. With numerous stocks in the market and ample new opportunities, staying invested for long in the same stock may get a little difficult. But only the long-term outlook can give you a fruitful result. Therefore, when there is a sudden slump in the market, one should not get out of the current positions. Warren Buffett says, our favorite holding period is forever. Hence, to be successful stock investor with a proper investor mindset, give enough time for your stock portfolio to grow. All you need to do is pick up the well-run businesses and then let it sufficiently mature to reap a result. Next, have a proper plan in place. While you're investing in the stock market, it's important to lay out a plan for future growth depending on your investment objective, return expectation, and risk-taking ability. It's important that before you aim to develop an investor's mind, you analyze your current financial situation and have diversification strategies in place to reach your investment objectives. Learn to accept the failure. Even the most successful investors have seen the failures at times. But what makes them stand out and know how to think about investing is that they have accepted the failures and moved on with the learnings from it. Understanding and accepting that losses are part of any investment process is the key to success. Take it this way, there are losses in business as well, but there will be success too. Speculator versus trader versus investor. Depending on how you would like to participate in the market, you can choose to speculate, trade, or invest. All three types of participation are different from one another. One has to take a stance on the type of market participant he would like to be. Having clarity on this can have a huge impact on their profit and loss account. What are investable grade attributes? Investable grade company has a few distinguishing characteristics, namely qualitative and quantitative aspect. The qualitative aspect involves understanding the non-numeric aspects of the business. The first factor is management's background. Who are they? Their background, experience, education. Do they have the merit to run the business? Any criminal cases against the promoters? Second, business ethics. Is the management involved in scams, bribery, unfair business practices? Third, corporate governance. Appointment of directors, organization structure, transparency, etc. Fourth, minority shareholders. How does the management treat minority shareholders? Do they consider their interest while taking corporate actions? Fifth, share transactions. Is the management buying or selling shares of the company through clandestine promoter groups? Next, related party transactions. Is the company tendering financial favors to known entities such as promoters' relatives, friends, vendors, etc., at the cost of the shareholders' funds? Seventh, salaries paid to the promoters. Is the management paying themselves a hefty salary, usually a percentage of profits? Eighth, operator activity in stocks. Does the stock price display unusual price behavior, especially when the promoter is transacting in the shares? Ninth, shareholders. Who are the significant shareholders in the firm? Who are the people with above 1% of the outstanding shares of the company? 10th, political affiliation. Is the company or its promoters too close to a political party? Does the business require constant political support? Promoter lifestyle. Are the promoters too flamboyant and loud about their lifestyle? Do they like to display their wealth? A red flag is raised when any of the factors mentioned above do not fall in the right place. For example, if a company undertakes too many related party transactions, it would send favoritism and malpractice. This is not good in the long run. So even if the company has great profit margins, malpractice is not acceptable. It would only be a matter of time before the market discovers matters about related party transactions and punishes the company by bringing the stock price lower. Hence, an investor would be better off not investing in companies with great margins if such companies score low on corporate governance. Quantitative aspect. The quantitative aspect are matters related to financial numbers. For example, cash held in inventory is straightforward. However, inventory number of days is not. The stock markets pay a lot of attention to quantitative aspects, which are profitability and its growth, margins and its growth, earnings and its growth, matters related to expenses, operating efficiency, pricing power, and matters related to taxes. Dividends payout, cash flow from various activities, debt, both short-term and long-term, working capital management, asset growth, investments, and financial ratios. The last aspect of this unit is management of risk in securities market. Risk management is a systematic process of identifying, assessing, and mitigating risks associated with an activity or investment. The main objective of risk management is to minimize the potential impact of risk on an investment portfolio while maximizing its returns. Risk management in stock market involves a comprehensive approach that considers various factors that can impact on investment portfolio. These factors may include market trends, economic conditions, political events, and company performance, among others. There are several risk management techniques that investors can use to manage risk effectively. One popular strategy is diversification, where investors spread their investments across different asset classes or securities to reduce the impact of market fluctuations on their portfolio. Other techniques include hedging, where investors use financial instruments such as options or futures contracts to offset potential losses, and active portfolio investment, where investment managers continuously monitor and adjust their portfolio in response to changing market conditions. How does risk management work? Risk management works by identifying potential risks, assessing their likelihood and potential impact, and implementing strategies to mitigate or avoid those risks. The risk management process typically involves several steps. The first is risk identification. In this, there is a need to identify risks that may affect the investment portfolio. This can be done through various methods like historical data analysis, market research, or expert opinion. Next is risk assessment. Once the potential risks have been identified, they are assessed based on their likelihood of occurrence and potential impact on the investment portfolio. This step involves analyzing the severity of the risk and probability of its occurrence. The third is risk evaluation. After the risks have been assessed, they are evaluated based on the priority and importance. This step involves determining which risks are the most critical and require immediate attention. Fourth, risk treatment. The final step in the risk management process is to implement strategies to mitigate or avoid the identified risk. This can be done through various techniques such as diversification, hedging, or active portfolio management. What are the type of risks? What are the type of risk management? Market risk management. Market risk is the possibility of suffering a loss as a result of fluctuating market conditions, like variations in interest rate, inflation, or currency exchange rates. This risk management involves using techniques such as diversification, hedging, and active portfolio management to mitigate the impact of market fluctuations on the investment portfolio. Credit risk management. Credit risks refer to the likelihood of enduring a loss as a consequence of a borrower's inability to pay back a loan or fulfill other financial commitments. This risk management involves assessing the creditworthiness of borrowers and implementing measures to mitigate the potential impact of default, such as collateral insurance. Operational risk management. Operational risk is the risk of loss due to failures in internal process, systems, or people. This risk management involves implementing controls and procedures to minimize the potential impact of operational failures such as contingency plan or disaster recovery. Liquidity risk management. The possibility of loss attributable to an inability to convert assets into cash when needed is known as liquidity risk. This risk management entails keeping enough cash reserves and putting in place procedures to guarantee that assets can be turned into cash rapidly if needed. Reputational risk management. Reputational risk is the risk of loss due to damage of a company's reputation or a brand. Reputational risk management involves implementing measures to protect the company's reputation, such as monitoring social media and responding quickly to negative feedback. Legal and regulatory risk management. Loss resulting from breaking rules and regulations is known as legal and regulatory risk. Implementing controls and processes to guarantee compliance with relevant laws and regulations is part of legal and regulatory risk management. What are the risk management strategies in stock market? There are several risk management strategies that can be used by investors in the stock market to mitigate potential risks and maximize returns. Some of them are given below. Diversification. Diversification is a strategy that involves spreading investments across different asset classes or securities to reduce the impact of market fluctuation on the portfolio. By investing in a range of stocks across different sectors, geographies, and market capitalizations, investors can minimize the impact of any one stock or sector on the portfolio. Second, stop-loss orders. A stop-loss order is an order to sell a stock if it reaches a certain price point. This strategy is used to limit potential losses in the event that a stock price drops below a predetermined threshold. Hedging. Hedging involves using financial instruments such as options or future contracts to offset potential losses. For example, an investor might purchase put option on a stock to protect against potential losses if the stock prices drop. Active portfolio management. Monitoring and altering the portfolio on a constant basis in response to shifting market circumstances is known as active portfolio management. In order to make wise investment selections, this technique requires assessing market trends, corporate performance, and economic data. Dollar cost averaging. Dollar cost averaging is a method in which constant amount of money is invested in a company at irregular periods, regardless of market conditions. This technique enables investors to profit from market volatility by purchasing more stock when prices are low and fewer shares when prices are high. Fundamental analysis. Fundamental analysis is an approach for determining company's inherent value by evaluating its financial statements, industry trends, and other pertinent data. This method is designed to uncover stocks that are expensive and have prospective growth chances. So students, we've come to the end of the presentation. Thank you for listening. We will study Unit 3 in the upcoming session.